There is a big risk with MPW. It is down 60% year to date, but there is also a lot of reward potentially as well. Now, we have been through this company many times. As we can see, their dividend safety score looks very unsafe. A potential dividend cut on the cards. We can also see articles where they discuss that potential 30% spike in the stock. There are also other articles that we see here. MPW has 363% upside to recover, but realistically we want to know, is the risk worth the reward? We're going to find out today. We're also going to run through the updated valuation based on their latest earnings and their latest numbers. And we've also seen on previous episodes where we've run through exactly what the CEO has addressed to shareholders. He talks about how he is a large shareholder. There's a lot of opportunity for MPW in the future. If you want to check that video out, it is on their website, so do go check that. It is from October, and since then the price just keeps tumbling and tumbling. It is down a whopping 60%. If you had held this over the last 10 years, down 62%. We do see its all-time high pretty much pre-COVID at $24, so 6 times off this current trading price. Now, we'll analyze this company again. We'll go and have a look also at their latest earnings, but we do have articles this month, a lot of them talking about a lot of upside to the company. Now, there are a few reasons why they state this. They do essentially see that the Federal Reserve will cut interest rates in 2024. That will significantly help not only MPW, but also essentially the REIT sector in general. They do see the risk for their Steward healthcare, which is essentially on the verge. And when we do take a look at some of the risks that they do talk about and the reasons why effectively they think there is a lot of reward, their population is aging, so the demand for healthcare will continue to rise. Now, why exactly has this stock been falling? Well, we can see it's not essentially difficult to tell, but they have got a significant amount of debt. And we can see as well that they essentially borrowed a lot of money when there was the zero interest rate period. And we can see, and we will analyze now to see what their total debt is. But at the point that this is discussing at 11 billion, and essentially their total interest increases. As the interest rate increases, their total debt increases, the expense that they have to pay on this debt continues to soar. And one of the ways they have dealt with this is essentially selling off assets in a bid to raise cash and deal with their maturities. Now, their latest sale were 4 properties in October, as well as a property or one of their Australian properties. So it's not really good when you are looking at companies that are selling their assets. Essentially, profits and revenues are coming from these assets, you would like to think. And we can also see other articles, as we mentioned here, coming in from only a few days ago, where they are saying that there's around 363% upside. So realistically, what is going wrong with this company? Let's take a look and let's understand whether or not the risk is worth the reward. So when we take a look at their income statement, and those who are regulars on the channel, they know for REITs, 5 to 10%. Look, I mean, they've essentially doubled their top line from 800 million in 2018 to around 1.6 billion. Yes, very, very nice to see. On top of that, what I do quite like to see is those increases year on year. And the trailing 12 months effectively showing us that they are expecting a drop in their 2023 numbers. Not massively, but they are still expecting a drop. But over the last 5 years, that top line has been increasing very positively. Bottom line, a slightly different story. It has gone from around 1 billion to 900 million. And we can see that massive drop to 2019, although it has picked up from that point. So top line, bottom line, slight inconsistencies there, but overall it is increasing on that top line. So they do need to figure out their bottom line to make this company more profitable in line with those increasing revenues. And cash and equivalents, well, it's gone from 821 million to 340 million, so they are holding less cash than they did 5 years ago. And in terms of that total debt, what we can see, 4 billion in 2018, nearly 3 times as much in their latest report of 10.2 billion. So they are holding a lot of debt. We can see that from those articles. They are essentially having to pay a significant amount of interest on those debts with those ever increasing rates, which they will have to refinance at some point. So something just to bear in mind. Now, essentially the industry as a whole, and we're looking here at essential healthcare REITs, so we do have a few that you may have heard of, Sabre Healthcare, Physicians Realty, and a few others. And what we can essentially see from this is MPW is one of the few that has had a negative return. So it's not like the industry has been poor with healthcare, as mentioned, aging population. You would expect this to be a very profitable business. MPW, however, the worst performing, down 55% year to date. And when we analyze the last 5 years, well, they're down 62%. Now, for me, that signals two things. One is that they have had a very, very horrific last few years, but it also signals to me, is there opportunity? It begs the question, is this a company that can have a very, very strong play over the next 5 years? As always, past performance is never an indicator for the future. Now, institutional ownership is 76%, and as we've mentioned, institutions have sold around 830 million over the last 12 months, with a little bit more buying from these same institutions in the same period. And we can see the last 2 quarters of 2023, a lot more buying than selling, the biggest one here being Q2 of 2023. Now, it doesn't necessarily mean we should buy just because institutions buy, but it is worth noting for those who are interested in these parts of the analysis. Now, before we dive into the dividend potential cut and the dividend safety as well as financial metrics, we can take a very quick look at their earnings. Now, Q3 23, they did beat on the top line. They missed on the bottom line. Q2, they missed on both top line and essentially their earnings per share. Similar story there for Q1. Now, when we also analyze the Q3 23 versus Q3 22, we also see they are bringing in less amount of revenue than last year, lower net income, as well as pretty much missing out on every single metric. So they are worse performing than last year. This is purely Q3 versus Q3 last year. So something just to think about there. Now, dividend safety score 20, very unsafe. It is the lowest score we have seen. So in my opinion, because it is this low, we will analyze the metrics, but it does seem that this dividend will be cut, although do note the current yield is sitting at around 13%. So let's go through some metrics, and we'll start off with recessionary metrics. They cut the dividend in the last recession, negative 5% sales, so above average growth, and they significantly underperformed the S&P with a negative 76% return versus the S&P's negative 55%. Now, there was a dividend cut this year, as we saw, negative 48. If I had to wager a bet, I would see another dividend cut incoming. And personally, I do think that that would be very beneficial for the company and even the shareholders. I think if we see another dividend cut coming, it may have some short-term repercussions on the share price coming down even further. But I do believe over the next few months that share price would go back up even higher than current trading price. Drop me your thoughts on that though below. I would like to hear what you think. Last 5 years, they have kept up with inflation. Last 10 years, again, personally, if you're keeping up with inflation and you are offering a yield of around 13%, happy days. Why would you not be happy? Now, dividend, in terms of dividend growth, they haven't really been paying any years due to the fact that they had that dividend cut. Now, dividend yield theory, it does show undervaluation as the current yield sits above the 5-year average. But remember, we never look at any of these models in isolation. Forward P to AFFO, it is below the 5-year average again of 4 versus 14. So again, another sign. And we can see the sector P to AFFO significantly higher for real estate. Now, do remember though, just because a company is right there towards the 52-week low, it isn't a signal for undervaluation. Neither, if it was sitting at the 52-week high, a signal for overvaluation. For REITs, adjusted FFO below 95% is the preference for medical REITs. So they are below that. 2021 and 22 at 82%, with 23 expected to be significantly lower at 76%. So again, that is positive so far on the dividend safety, so we can kind of understand why this dividend is safe, but let's keep going. Adjusted FFO, 93 cents in 2013, 142. It does increase, maybe not as consistently or rapidly as you would like, but it does go in the right direction. Do note 23 expected to come down to 135. Now, when we look at the sales growth, double digits is what we like to see from REITs, moderate growth 5 to 10%. What we are seeing the last few years, we do see double digit, very nice increase as we analyzed. In fact, quite a very nice analytical period for the last 10 years. 2022 though, just a 1% increase, so below inflation, and 23 negative 12%. So we can start to draw a picture as to why this company has performed very badly on top of their increasing debts, their interest payments, selling assets to essentially stay on top of their debt. These aren't really positive signs, but you have to take everything in as a whole. Shares outstanding, typical with REITs, your position as a shareholder is being diluted. But again, I would say for REITs, just analyze how quickly the dilution is happening, as some companies dilute you quicker than others. Now, ROIC, 1 positive, 3 to 5% for REITs is what we aim for, or what I personally aim for. It does mean that management are able to effectively allocate their capital. With other companies, it's 10% or more. So very nice to see, although do note that it does drop to 3% in 2023, or that is expected. Operating margin, again, very nice to see, high 60s all across, although again, this does drop in 2023. So it is also about understanding whether or not you believe this company will have a better future in 2024 and beyond. Net debt to EBITDA, so the number of years it would take the company to pay off all of their debt net of cash on hand, 7.54 in 2022. Now, the maximum we want is 6 for the preference for medical building REITs. 23 expected 8.33, 24 expected 8.66. So we can now start to see why a dividend cut, or why the dividend safety, in fact, is sitting at 20, and that does make me believe and conclude that their dividend cut is likely on the cards. But personally, I would say that this is a benefit to shareholders. I think that will relieve the stress and pressure from the company and will really help with moving the share price back to the 52-week high that we saw not too long ago. Now, in terms of the valuation, as always, if you enjoy the content, values being provided, smash that like button, hit the subscribe and bell so you are continually notified of these videos as they drop. And don't forget, if you want to grab a copy of the valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio, then do click on that pinned comment below. Graham's valuation, it isn't one that we will use for REITs typically, so we will not be including this in our final calculator, but just to show you how the earnings per share comes about, because this will relate to the next model, is we have gone for essentially the average of the trailing 12 months and the last 2 years, as if we were using the trailing 12 months it would be negative. So moving on to the first model we're using, it's the multiples valuation model. We have ticker symbols here, the companies that we ran through on the 5-year return, and we get to the average P to AFFO, with the P to AFFO for MPW very low. This gives a stock price based on the multiples of $15.41. Now, when we take a look, that is significantly higher, just below a 4x on the current trading price, and slightly higher than the 52-week high, showing some strong signs of undervaluation. We then look at the dividend discount model, where we have the yearly dividends. Now, average growth, -7. Now, this is due to the fact of that dividend cut. Now, forward looking, I believe I've gone a bit more optimistic, as I do believe there is a dividend cut on the rise. But as always, if you do want to play around with the numbers, you can grab a copy of the model to get what you believe. So this gives a DDM price of $7.76. Now, that is some nice upside to the current trading price and within that 52-week high, so it does show some signs of undervaluation. But as always, this number will depend on the investor and what they believe. DCF model, now we have the free cash flows year on year, the average growth rate, forward-looking analyst estimates. With that discount rate, we get the essential present value of future free cash flows, add them together with the terminal value and cash, subtract total debt, get to the equity value, divide by shares outstanding, to get a DCF price of $9.21. Again, nice upside to the current trading price, but below the 52-week high. Now, the intrinsic value is, as always, just the average of the 3 models. And if you enjoy the content, values being provided, don't forget to smash that like button, hit the subscribe and bell so you are continually notified of these videos as they drop. Now, yes, 10% is what I'd use if I believed it had a wide moat, strong financial metrics, and good forward-looking data. But with MPW, let's be honest, there is a lot of risk. They are selling their assets to bring that total debt down, because they are paying a large amount in interest on that debt. So it is something to be aware of. Yes, I am also essentially pro-dividend cut again, but I do believe that will have a very positive connotation for the company. Now, margin of safety, we can bring it all the way down to 50%. It's still a buy. And at 55%, you're pretty much at the current price. So personally, I do believe it comes down to the risk reward for every investor. We have also reviewed companies like Alibaba on the show. So it really depends what type of risk you're looking for, what rewards. There are companies that you can invest in, like MasterCard, Visa, Microsoft, the ones that you know will be strong. They've got strong financial metrics, but at the same time, you know they're either overvalued or trade at a premium, whereas you have companies that you may want to take a risk on or not, completely down to the investor, and you should always do your own due diligence. So yes, we believe this currently has a margin of safety of 55%. In terms of what Wall Street say, well, they believe there to be some nice upside to the current trading price as well, slightly lower than 100%, going around 713 over the next 12 months. As always, though, do let me know your thoughts in the comments below. Is this one that just has too much of a risk to reward for you to buy? Is it one you've sold? Or if you're on the sidelines, let me know your bullish and bearish thoughts around this company. As always, if you want to grab a copy, click on that pinned comment below where you can pick up the value calculator to get to the intrinsic value and acceptable buy price of companies in your own portfolio. Don't forget to smash the like button if you've enjoyed today's content, hit the subscribe and bell button, and see you all in the next one.